Welcome back to the channel. A lot to unpack, a lot to talk about this week. Focusing in on headline inflation. What is the data telling us as Canadians? What could the data be telling the Bank of Canada? Super important conversation now that we got this potential data from the headline inflation number, talking about what you should be preparing for, especially if you're thinking about taking a variable rate mortgage. All that this week. Once again, welcome back to the channel. Thanks for stopping by. If you have not subscribed to the channel, we invite you to subscribe to the channel, hit that notification bell. Don't forget to like, share the video, help get this content out to as many Canadians as possible. But more importantly, let me hear from you in the comment section below. What are your thoughts on the Bank of Canada's next move? Now, here's what we have to think about right now as we approach July 30th, the end of next month, with the Bank of Canada meeting. Obviously, we have headline inflation coming in this week of June 24th, coming in at 1.7%, aligning with expectations. Many of the movers and shakers, banks, economists, all predicted that inflation was going to come in at 1.7%, and it came in as expected. Now, ultimately, with core medium trim, those are the numbers that the Bank of Canada really pays close attention to, basically leveling off. It could give the Bank of Canada the cover it needs to continue its pause moving forward. Now, ultimately, not really a lot to call home about with this most recent data. I mean, many Canadians will argue that the CPI headline inflation, or Stats Canada, really does a poor job. Inflation is much higher than 1.7%, even when you strip out the volatile things like food and energy, which every Canadian needs to eat, and we need to get to work in order to pay our bills. So ultimately, at the end of the day, this is the data that's provided. This is what the Bank of Canada is going to use to make their decisions next month. Now, keeping in mind, there's a few things we need to understand. Right now in the US, they just basically had held the rates as well. Continuing that pause in the US, there is conversation right now in the US that there might be potential for another 2 rate cuts by the end of the year. And as the clock continues to tick, and we are now in June, there's another 6 months before the year ends. It doesn't give much time for the Bank of Canada or the US Fed to make that decision. I believe the Bank of Canada, if they do believe that the Canadian economy is as resilient as they previously forecasted based on Q1 earnings, we'll see how exactly on Q2. But ultimately, here's the reality. I think the Bank of Canada is going to pause. They're going to hit that wait and see button because once again, they did make some catastrophic mistakes the first time around. Now, once again, it can go both ways, right? They could wait too long and the damage is done, or they can move too soon and create more inflation. And remember, the Bank of Canada's modus operandi is basically they want to make sure the inflation stays at that 2% mark. Now, we're well below that 2% mark with headline inflation. But the reality is, nobody really knows what the Bank of Canada is going to do next. What we do know is ultimately what's happening around the world, what's happening with the geopolitical tensions, as those subside, the trade war. Are we going to get a good deal? Are we not going to get a good deal? Is Donald Trump, coming up in July going to increase those tariffs? What is the, tariffs going to look like? Remember, there was that pause. So a lot of that conversation has been put to the wayside as the political tensions in the Middle East sort of had been overshadowed everything else. But now, as all these things come to the front, we need to see exactly how things play out and what Canada and the Bank of Canada decides to do next. Remember that. Now, as a Canadian with a variable rate mortgage myself, and talking to a lot of Canadians who have a variable rate mortgage, thinking about a variable rate mortgage, it's important to understand a few different things. Number one, if you haven't checked out our video from last week where we talk about the rates, please do so after this video, just so you can stay up to date with what's happening. We do those, so make sure you're subscribed to the channel. The other thing is to understand that right now, if you are taking on a variable rate mortgage in this environment, it's not as attractive as it could be to take a fixed rate mortgage at this particular point. There was a time when variable rate mortgages were much better priced, and that was something that many Canadians, a lot of voices on Facebook and YouTube and Instagram and all these social media platforms, X, Twitter, we're sort of promoting. But I really think it's important to understand that, yes, if you've taken a variable a while back, you would have been able to see your potential payments or interest that goes towards the principal on that variable rate mortgage increase, or you see your payments drop. Remember, there's 2 types of variables. There's the static payment variable where your payments remain the same, and then there's the adjustable rate product. So it's super important to understand those 2 differences. Right now, the prime lending rate, which is now still 4.95%. You're seeing some of the discounts anywhere from prime minus 40 to 80, 90%, or basis points, I should say. So you're still sitting in the low fours. There are some products that are in the environment right now that are in the low 4%, below the variable rate products, even some 399s out there for insured products, mostly for conventional, like we talked about. You not really as many as we like to see, and ultimately those are dedicated for renewals if you're a specific client with a specific mortgage. And I know we've talked about this on the channel before. It shouldn't be news, but I do want to reconfirm that if you do have a really small mortgage, chances are the rate will get impacted. If you have a larger mortgage, some banks do fight for larger mortgages. Believe it or not, some banks fight for smaller mortgages. So just make sure you're putting up a fight. I think that's what it is. Talk to a mortgage professional, get your options, get your solutions, especially if you're shopping online. I mean, understanding what those lenders are. A lot of times you get questions about, hey, I see these rates online. It's comparing apples to apples. As I said, a lot of times these rates that you're seeing being offered online are not with traditional, top major banks. So you have to understand that you might be forfeiting your line of credit if you have one. If you want a line of credit, some of these banks may or may not offer it to you. So understanding what's the trade-off, a slightly better rate for the product, or for a less superior product, that's what you need to understand, what it is that you're doing with your mortgage. Now, when it comes to taking a variable rate mortgage right now in this environment, like we talked about. So let's look back, and say, hey, the Bank of Canada might continue their pause. So taking a variable rate mortgage, maybe seeing another 2 cuts right now, is it better to take that variable now with the anticipation of those 2 cuts? That's really the question you need to ask yourself, is what is your risk appetite? What is your job stability look like? And what is the difference in your payments? It's understanding the key components. If the difference between a 25 or 40, 50 basis point decrease or increase in the mortgage is not going to make or break your payments and your lifestyle, then, a variable rate mortgage is something that you need to consider. But if you're living dangerously on the edge and you take that variable with the anticipation that things can go down, or, potentially things can go up, this is super important, right? That razor's edge could throw that budget, your family budget, out the window, especially if you're already paycheck to paycheck, or you're right with a lot of debt and you're not looking to refinance because, you can't, or maybe the opportunity is not there. Something's happened catastrophic to the income. Maybe a person's not working. I mean, look, there's all kinds of scenarios that could lead to something along those lines. But what's really, really important to understand is having a conversation with a mortgage professional, making sure that you're not self-diagnosing your problems. And a lot of times you can go online, you can go through chat, there's all these things. But speaking to someone who eats and breathes, sleeps mortgages and understands the nuances is definitely going to be worth its weight in gold. But at the end of the day, taking that variable rate mortgage, you have to understand a lot of people, especially because a 5-year variable is the most aggressive. That's where you're going to see that big discount, right? There are some banks that offer a 3-year, but the aggressive discount isn't really on those, it's on the 5-year. Now, ultimately, it's a 3-month penalty with most variables. Be cautious about that. I mean, it could be a 3-month penalty based on the prime rate, or it could be on your contract rate. So really important to understand those nuances as well. But the reality is most people set and forget their mortgage, right? Especially if you're taking a 5-year product, you've gone through all the exercises, mortgage approaching mortgage renewal, creatures of habit. You start researching, you start going online, and the algorithms pump all that information into your news feeds, into your Instagram, into your YouTube. Then, you get your mortgage done and that's it. And you're back to checking on how do-it-yourself videos or other stuff on the social media. And then that stuff gets put to the wayside. Maybe you're not paying close attention to the news outlets. And realistically, you may miss that opportunity to lock in, because with a variable rate mortgage, yes, you can get into that opportunity where you can take a lower rate right now. If fixed rates drop, you can lock in to a fixed rate product at that particular time. But it's important. This is the key thing. So if you take a 5-year mortgage, it's variable, and year one, you ultimately see that the fixed rates are lower. Let's say next year rates drop. You can't lock into a new 5-year, or you can't lock into a 3-year. You have to take the 4-year, right? For example. So it's the same principle. As you go down in the term, that's the term that you have to take, and it's locked in for that particular period of time. And then, although you can ride it out without a penalty, switch from a variable into a fixed without penalty. If you break that mortgage, once you've locked in, then the full penalty applies. So why not weigh out your options and take a shorter term 3-year fixed if you're not sure? Right now, probably wouldn't be taking a 5-year fixed. I would be leaning on a 3-year fixed or 5-year variable, where the penalties are more in your favor than in the bank's favor. So we'll leave the video here. Let us know your thoughts. Let us know your concerns. If you have questions, always feel free to reach out to our team here at InTouch Mortgage Solutions. We'll make some time to walk you through the process. Once again, don't forget to leave those comments in the comment section below, and we'll see you all next week. Thanks for stopping by.